All right, welcome back, everybody. Today we're going to talk about the top 3 end-of-year tax planning moves to assess for your situation this fall. So I find that the end of year is a great time to do tax planning. It's a big topic item for our fall meetings that are coming up here. And I just want to go through 3 of the top strategies that I'm seeing being implemented with my clients and are something that might potentially make sense for your situation and something to think about each and every year. End of year is so great for tax planning because we have most of that income data. We've had bonuses, we've had maybe things that have happened throughout the year. We've sold stock. We have, a pay stub in the fall that's kind of taken into account a lot of our income that's come through our paycheck throughout the year, as well as the associated tax withholdings. So we kind of know where we stand from a tax perspective. There's not a lot of surprises. Usually, if we're looking the rest of the year, October, November, December, there might be maybe a bonus in December that could throw us off or something depending on who our employer is. But that's why the end of the year is such a great time to look at and think about tax planning. So the 3 strategies that I want to talk about today are Roth conversions, charitable contribution planning with donor advised funds and RMDs to charity, and then retirement account contributions. Roth conversions. What is a Roth conversion? That's when we take traditional pre-tax money that we've contributed to at some point, which has bypassed taxes, right? It's gone from our gross pay all the way into our traditional account. We haven't paid taxes on that. We get a tax deduction that year. That's great. In a future year, though, at some point, we may want to take that money, convert it to a Roth account, and pay the taxes on it that year. Why would we want to do this? Well, if we think that our income is potentially in a lower tax situation than it might be in the future. We're in a low income tax year for whatever reason. Maybe we got out of the military and our income drops. Maybe we started a business and our income's really low because we're in startup mode. Maybe we're taking a year off, we're taking a sabbatical. Maybe we retired early and we haven't started taking Social Security or required minimum distributions from our accounts at age 72 or 73 now. So there could be a number of reasons why we're in a low income tax year. If we look historically at tax rates, we're in a relatively low income tax environment, and that will likely change in the future. So it's a really hard thing to say exactly what's the perfect amount of Roth money to convert each and every year, and what's the perfect year to do this. It is a little bit of a guessing game, but with some of that info and with some of that future projection, we can reasonably estimate, hey, this might be a good year for a Roth conversion. Let's take some of that traditional money and convert it to Roth. Why is that important in retirement someday? Well, when we retire, if we're planning on making $120,000 from Social Security and distributions from our traditional accounts, and all of a sudden we want to take the grandkids and the whole family to Europe on a cruise, and it might cost $40,000, and we can totally swing it. Great. Well, if we pull that from our traditional accounts, well, that might do something to our taxable income. What's that going to do to our Medicare premiums? What's that going to do to our tax rate? It's a big problem. So having that post-tax Roth bucket of money is super, super important in retirement. What does it also do for our legacy someday? Well, we get to leave that tax-free bucket to our heirs so that they don't have tax problems when they're inheriting this money. So it's having tax diversity in our accounts is super, super important in the distribution and spread of our accounts, and building up that Roth bucket is really important. So Roth conversions, really, really big strategy, especially for those that are in those gap years in between maybe a retirement or a decrease of taxable income, but they haven't started drawing that Social Security and taking RMDs yet, required minimum distributions. Speaking of RMDs, let's get into the next strategy. So the next one that I'm seeing is donor advised funds and RMDs to charity. So let's talk about just charitable distribution planning. So can we take deductions for contributions to charity? Yes. However, due to the Tax Cuts and Jobs Act of 2017, right, going to expire as of right now, January 1st of 2026. There's an increased standard deduction to something over $29,000 in 2024 for a married couple filing jointly, almost $30,000. So most people, unless they have a hefty mortgage and pay a lot of state tax, a lot of people are not itemizing those deductions. So a lot of times if we're giving $1,000, $2,000, $3,000 to charity, it's not really benefiting our tax situation. One thing that I'm using with some clients this year is a donor advised fund. And what that is we could take stock, we could take cash. It's really advantageous when we take stock, appreciated stock that has gains in it. Let's say $20,000 of stock, that is $10,000 of long-term capital gain. We take that appreciated stock, we contribute the whole thing to a donor advised fund. What that does, that gives us a $20,000 deduction this year, the full value of that stock. Instantly, when it's in that donor advised fund, it can be sold and reinvested however we want. It's already gone in the eyes of the IRS. It's already been donated to charity. So we get to now take $20,000, put it on our tax return as a charitable deduction this year. What does that do? It's super powerful. If we're in a high income tax year, that's $20,000 less in taxable income. If we're already itemizing, we get to add $20,000 to that number. If we're marginally, our tax rate is 25%, that's a $5,000 reduction in tax. What does it also do now? It also allows us to avoid capital gains tax on that $10,000 gain. Because we put it in the DAF, it's sold, it's under that wrapper, we avoid that gain completely. So instead of selling appreciated shares of stock and reallocating towards maybe a more diversified portfolio, we get to take those appreciated shares, maybe it's NVIDIA, maybe it's Tesla, whatever it may be, contributing it to the DAF, and then we can invest in a taxable brokerage account, separately. But we just get to avoid that capital gains tax, as well as take that charitable deduction this year, that large charitable deduction in a high income tax year, as well as be able to give to charities and causes that we care about on our schedule anytime. The money's in the DAF, we could call it the Baskin family DAF, or whatever your family is DAF, right? And we can write checks from that DAF anytime we want for the next 20, 30 years. We can just continue contributing to it. We could sit there and let it grow and let it invest. Super, super powerful strategy. With that, another strategy, these are for those that are in retirement and subject to required minimum distributions, is taking RMDs and giving them straight to charity. That allows you to, again, take that required minimum distribution. The IRS makes you take a certain amount out once you're in your 70s. It's a complicated formula a table that they have is a divisor depending on how old you are, based on how long they think you'll live. But basically, the IRS says, hey, this traditional bucket of money that you never paid taxes on, we want our money. So you have to take this amount out. What some people will want to do then is, if they're giving to charity, just give some of that straight to charity. And then they don't get taxed on it at all. It satisfies their RMD, and it's not going to increase their taxable income for that year. So for charitable contribution planning, DAFs and RMDs directly to charity are two really, really good strategies. Okay, number 3, retirement account contributions. So this is more of a broad category, something that encapsulates quite a few components. But in general, contributing to retirement accounts is probably going to help not only your net worth, your wealth, but it can also really help your tax situation if we're doing it in a smart way. One way specifically, like I can say for business owners, like business owner clients, like contributing to retirement accounts is going to help a lot if we're doing it in a traditional capacity for a high income business owner, contributing to traditional SEP IRAs, traditional solo 401ks, whatever it may be. We get to lower taxable income this year, put money away for retirement, diversify away from our business. It's usually a huge win. Doing the same thing for a Roth account might make more sense. Roth solo 401ks. They don't have Roth SEP IRAs, but not going to lower our taxable income, but going to build up that tax-free bucket. We talked about how important that was earlier. So retirement account contributions, especially for business owners, something that we're talking about this time of year. Also, just for everybody, Roth IRA contributions, not going to lower your taxable income this year, but still good tax planning. Backdoor Roth contributions, a little bit more complicated, but we're getting money for high income earners into traditional IRAs, and then we're rolling that to Roth IRAs. So we're getting money in the Roth IRA through the backdoor because we're not eligible because we make too much. A good time to be thinking about Roth versus traditional for next year, maybe. Retirement account contributions in general can be just obviously really beneficial for your wealth, but especially if you're a business owner, really good way to potentially lower taxable income this year with like a big lump sum contribution. If you work for an employer, if we're just W-2, harder to obviously make that contribution, like one big contribution like that. It doesn't really work like that. We have to adjust our percentages on our pay stub and comes out monthly, but this is a good time of year to think about that in the context of your tax situation. So that's it. Those are the 3 big strategies that I'm implementing with clients this year. Roth conversions, okay, converting money from traditional to Roth in years that we think income's a little bit lower than it will be in future years. This can save anywhere from tens to hundreds of thousands, even millions of dollars when we do this scenario and draw this out until death. Super, super powerful for almost everybody at some point in their life. Number 2 is charitable deduction planning. So this is like DAFs is the big one, donor advised funds that I'm using, and then RMDs directly to charity. I can say for donor advised funds, the effects of some of those planning strategies this year in a couple instances are saving like $5,000 to $10,000 in tax. And then retirement account contributions being the last one, especially for business owners, those that are in higher income years, contributing to traditional accounts, driving that taxable income down. Net effects of that, if we just do some quick math, if we're making a max contribution for a specific business owner at $20,000 a year to a solo 401k, SEP IRA, and they are in a 25% marginal tax bracket, we'll just say 40% marginal tax bracket, that's going to drive down their taxable income by 20 grand. It's going to save them 8 grand on tax this year. So these are all really, really powerful strategies that can save lots on tax this year or in the future, depending on what makes sense in your situation. End of year is an awesome time to be assessing these strategies and how they might make sense for you, because again, we have all that pay data from the year. We kind of know what's going to happen. We have the hay is in the barn, if you will. Like, we know what has happened this year. We know generally what our tax situation will be. We can kind of play some games and pull some levers at the end of the year to have an optimal outcome for our tax situation. So I hope that this was helpful. If you have any questions, please feel free to reach out. Let me know. Inbox is open. And thank you for being here again. Please rate and review on Spotify or Apple if you're listening there. It would be super helpful. I've really appreciated the feedback thus far. Thanks so much. We'll be back in a couple weeks with another episode. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com, where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back next week with